One stock sector that is an important source of dividend income for me is U.S. equity REITs. REITs are pass-through entities whose income is not taxed at the corporate level, provided it is distributed to equity owners. The technical requirement is at least 90% of the net income has to be distributed in order to maintain the tax status of a REIT. REITs will generally pay out all of their net income as calculated using a GAAP accounting standard, and will add to that most of their free cash flow. This tax status avoids double taxation, which occurs when a regular corporation pays a dividend. The corporation is first taxed on the income used to fund the dividend, and the individual who receives a dividend pays a tax also. The result of the favored U.S. tax status of a REIT is that there is no double taxation. Equity REITs will own income-generating properties and need to be distinguished from U.S. mortgage REITs that are on paper assets and utilize significantly more leverage. I do not like mortgage REITs. I have been talking about cash flow in several recent videos. Free cash flow, as I'm about to define it for REITs, is important when assessing dividend coverage, and is also important, in my opinion, for valuing a REIT stock. REIT GAAP income will frequently be negative or slightly positive, mostly due to the non-cash depreciation expense associated with owning real property, which will be substantial. A common cash flow number for equity REITs is called funds from operations, or FFO. The main add back to GAAP net income will be the non-cash depreciation expense. Generally, the most important subtraction from GAAP net income would be gains from property sales. FFO will be close to what I call funds available for distribution or free cash flow only for triple net lease REITs, where the tenant is responsible for paying for maintenance expenditures, property taxes, and insurance on the property. To arrive at a true free cash number for triple net lease REITs, other adjustments are generally necessary, such as adding back the non-cash stock compensation expense and deducting per 10 revenues that are created by what is called the straight line accounting convention. Per 10 cash revenues are not available to support the dividend. FFO is not, in my opinion, a proper free cash flow number when the property owner starts paying for tenant improvements and maintenance expenses. That is particularly true for apartment and office REITs and other REITs that focus on multi-tenant properties rather than leasing to a single tenant per property. Maintenance expenditures for those properties can be substantial uses of cash during a quarter. The FFO number for those kind of REITs needs to be adjusted for those kinds of expenses and non-cash revenue to arrive at what I call cash available for distribution or funds from operation, which may also at times be referred to as adjusted funds from operation, AFFO. But this can at times be misleading when a REIT uses AFFO, as it is not equivalent to funds available for distribution, since some kind of cash expense is not excluded from the FFO number. In my post published yesterday, I discussed the REIT Kite Realty, symbol KRG. I have owned the bonds of this REIT. This was my first common stock purchase. KRG owns mostly multi-tenant retail properties anchored by grocery stores. I would not use FFO to evaluate dividend coverage for KRG for the reason that it is a multi-tenant landlord where it is going to end up paying for maintenance expenses and often tenant improvements as well. I discussed the FFO number for the third quarter was 51 cents per share, and the cash available for distribution was at 33 cents per share, or substantially lower. It is the cash available for distribution number is still more than the common share quarterly dividend of 25 cents per share. It is important to recognize when a REIT may be in trouble sufficiently that it will need to cut the dividend, and that will frequently occur when the cash available for distribution does not cover the dividend at all. It may be several cents short or even more. It is also important to evaluate the growth in funds available for distribution over time. And I mean per share as opposed to the dollar amount, which in many cases has increased over time without increasing meaningfully or at all the per share number, which is the relevant number for me.